Welcome to True Dinar Inside. We cut through the noise to bring you the unfiltered truth about the Iraqi dinar. For years, you've been sold a dream, a fantasy whispered in the dark corners of the internet that any day now, a secret switch would be flipped and the Iraqi dinar would magically revalue to make early investors unimaginably wealthy. I'm here to tell you that the switch has indeed been flipped, but not in the way those online gurus have been promising you for a decade. The real switch is the shocking and deliberate move by the Central Bank of Iraq and global financial institutions to aggressively defend the current exchange rate, pouring billions of dollars into a financial war to maintain stability, not to trigger a windfall. While hype artists point to every minor economic meeting as a secret signal for the long-awaited RV, the cold, hard data from the trading floors tells a completely different and far more compelling story. As of the latest 2025 data, the Iraqi dinar remains steadfastly pegged, trading within a tight band of 1,310 to 1,320 IQD per US dollar, a testament not to an impending explosion in value, but to a calculated and expensive campaign of control. This reality is backed by Iraq's formidable $95 billion war chest of foreign currency reserves, a financial firewall that the central bank is actively using to crush speculation and ensure the dinar's peg holds firm against immense market pressures. Imagine the entire online RV community waiting for a fireworks show of profit, while in Baghdad, the real story is a grueling, high-stakes battle in the trenches of monetary policy where the primary goal is survival, not spectacle. The International Monetary Fund has consistently and publicly stated that a sudden, massive revaluation is economically unfeasible and would be catastrophic for Iraq's import-dependent economy, a fact that gets conveniently ignored in all those exciting YouTube videos that promise you a private jet. The true narrative, the one that doesn't get clicks, but is grounded in brutal economic reality, is that Iraq is fighting a multi-front war against dollar smuggling, political instability, and its own deep-seated structural issues. And the central bank's primary weapon is stability, not volatility. So, if you've been waiting for a life-changing text message from your currency dealer, you're focusing on the wrong signal entirely. The real signal is the daily auction results from the Central Bank of Iraq, where the amounts of dollars sold reveal the intense pressure the dinar is under just to maintain its current value. Every single day, the bank has to inject hundreds of millions of dollars into the system to bridge the gap between the official rate and the much weaker black market rate, which can be as high as 1,450 dinar per dollar, a glaring indicator of the true market sentiment. This isn't a sign of an impending revaluation. It's a symptom of a currency under severe distress, being artificially propped up by the very institutions that the gurus claim are orchestrating a global reset. The recent news isn't about a new global rate for the dinar. It's about the World Bank and IMF applauding Iraq for its commitment to maintaining financial stability through these defensive measures, a far cry from the explosive growth narratives you're being fed. The entire foundation of the RV theory collapses under the weight of simple logic. Why would a country deliberately make its exports, which are overwhelmingly oil, more expensive on the global market by making its currency stronger overnight? It's an economic suicide mission that no credible government would ever undertake. The real flip of the switch is the slow, painstaking, and utterly unglamorous work of modernizing Iraq's financial infrastructure, combating corruption, and weaning the economy off its total reliance on crude oil. This is the true journey of the Iraqi dinar, a marathon of reform, not a sprint to a fantasy finish line. And if you're still listening to those voices telling you to buy more dinars based on a secret bank document or a cryptic phrase from a politician, you are fundamentally misunderstanding the most critical rule of currency investment. Value is built on economic fundamentals, not on internet rumors and wishful thinking. The most valuable intelligence you can get right now isn't about a mythical rate change. It's about understanding the immense pressure building beneath the surface of that stable-looking official peg and recognizing that the central bank's monumental effort to hold the line is the only thing preventing a devaluation, not setting the stage for a revaluation. Now, if the central bank is so powerfully defending the current exchange rate, you have to ask the billion-dollar question: why is there so much intense, non-stop chatter about a revaluation happening right now in 2025? The answer lies in a global financial earthquake that has nothing to do with Iraq directly, but everything to do with the lifeblood of its economy, the US dollar itself, which is currently experiencing its most dramatic and unprecedented decline in over 50 years, creating a perfect storm of speculation and hope that the gurus are exploiting for their own gain. The first half of 2025 was, by the data, the worst period for the US dollar in half a century, with the dollar index plummeting by a staggering 10% year-to-date, a collapse that immediately forces every nation tied to the dollar to recalibrate and send shockwaves through every emerging market currency, including the Iraqi dinar. This isn't just a minor fluctuation. This is a fundamental shift in the global financial landscape, driven by a capricious U.S. trade policy and mounting serious doubts about America's long-term fiscal strength, which has triggered a historic rush by central banks worldwide to de-dollarize their reserve assets and seek safer havens for their wealth. And what is the ultimate safe haven asset when confidence in the dollar wavers? It's gold. And the price of gold has just shattered the $4,000 per ounce barrier, a meteoric rise that screams one thing to the market: institutional investors are losing faith in traditional pillars and are desperately searching for stability, which in turn creates a fertile breeding ground for rumors that a petrocurrency like the dinar, backed by vast oil reserves, is the next big thing. This is the real switch flip the banks are dealing with, not a secret revaluation plan, but a frantic global pivot away from dollar dependency, and Iraq, with its dinar pegged to that very dollar, is caught directly in the crossfire, forced to spend its valuable reserves just to maintain stability, while speculators see a golden opportunity. The intense volatility in the $7.5 trillion a day Forex market is absolutely staggering, with platforms reporting volume surges of up to 21% in a single month following major geopolitical or tariff announcements, followed immediately by double-digit drops when the news cycle quiets down, proving that we are in a period of extreme, whipsawing reactions where hype can very easily be mistaken for genuine financial movement. This is the toxic ecosystem where the dinar revaluation myth thrives, a world of high-frequency trading, algorithmic reactions, and a widespread, shocking reliance on manual processes where a third of fund managers still use email and telephone calls to execute multi-million-dollar FX transactions, a slow-moving system that is easily overwhelmed and manipulated by digitally fueled rumors that spread at the speed of light. So, when you see a headline screaming about the dinar's new global rate, you are not looking at a leaked central bank document. You are witnessing the fallout from a weakened dollar, a flight to gold, and a technologically fractured trading system that amplifies every whisper into a potential market-moving event. The real pressure on the dinar doesn't come from a planned appreciation, but from the immense internal strain of this new global reality, where the gap between the official rate and the black market rate can stretch as high as 1,450 dinar per dollar. A dangerous chasm that the Central Bank of Iraq must constantly bridge by auctioning off hundreds of millions of dollars from its reserves just to prevent a full-blown devaluation. Think of it like this. While online gurus are selling you a dream of a luxury life from a revaluation, the central bankers in Baghdad are fighting a daily trench war against dollar smugglers and a global dollar decline, using their $95 billion war chest not to make you rich, but to stop the currency from collapsing under the weight of these very real, immense pressures. This is the brutal, unspoken truth of the dinar in 2025. Its story is not one of isolated growth, but of a desperate, expensive defense against a global financial tide that is turning against the US dollar, and your investment fantasy is merely a piece of collateral damage in that much larger, more complex economic battle. The next time you see a video about the dinar revaluing, I want you to immediately check the real-time price of the US dollar index and the spot price of gold. If the dollar is down and gold is up, you are not seeing evidence of a dinar RV, you are seeing the exact same macroeconomic conditions that make the dinar's stability more expensive and difficult for Iraq to maintain, which is the polar opposite of the conditions needed for a miraculous, wealth-creating revaluation. So, after understanding the brutal economic defense of the dinar and the global dollar storm creating all the noise, you are now faced with the ultimate question: what comes next for the Iraqi dinar in 2025 and beyond? And more importantly, what should your strategic move be right now? The realistic roadmap for the Iraqi dinar is not a dramatic, overnight revaluation, but a slow, grinding path of incremental progress entirely dependent on Iraq's ability to execute deep structural reforms, a process heavily supported but also heavily policed by the International Monetary Fund, which has approved a crucial $5.34 billion loan to help stabilize the nation's finances, but which also demands strict fiscal adjustments and anti-corruption measures in return. The most probable scenario, with about a 60% likelihood according to expert analysis, is a continued era of managed stability, where the Central Bank of Iraq uses its substantial $95 billion in foreign exchange reserves to keep the dinar pegged firmly within its current range of 1,300 to 1,320 IQD per USD, ensuring short-term predictability, but foregoing any dramatic appreciation that speculators dream of. However, there is a more optimistic, bull case scenario with about a 25% probability where successful implementation of tax reforms, a sustained recovery in oil production, and genuine political cooperation could lead to a gradual, single-digit percentage strengthening of the dinar over the next 12 to 18 months. A modest but real gain built on economic fundamentals rather than internet hype. This potential is further underscored by significant foreign investments pouring into the country, such as the $27 billion Total Energies project and multi-billion-dollar commitments from Qatar and Saudi Arabia, which bring not just capital but also crucial international credibility and technological expertise to Iraq's struggling infrastructure. Yet, we cannot ignore the persistent 15% probability bear case, where a sudden drop in global oil prices, a major internal political rupture, or a severe escalation of regional security tensions could trigger capital flight, rapidly deplete the central bank's reserves, and force a painful double-digit devaluation of the currency to restore competitiveness, a nightmare scenario that would devastate the purchasing power of ordinary Iraqi citizens and wipe out speculative holdings. The true switch flip for long-term dinar strength lies in monumental projects like the Development Road Initiative, which aims to connect Iraq with Turkey and the Gulf states, transforming the nation into a regional trade hub, and in the central bank's aggressive push for a digital banking revolution, with over 70 digital banking license applications currently under review, a move that could dramatically reduce corruption and increase financial inclusion. Your takeaway must be this: the dinar's future is not a mystery to be solved by decoding politicians' speeches. It is a calculated risk assessment based on 5 tangible drivers you must monitor weekly: Iraq's central bank reserve levels, its monthly oil export reports from SAMO, updates from IMF Article 4 consultations, OPEC Plus production decisions, and the ever-shifting landscape of domestic political stability. The fantasy of the dinar revaluing to make you an instant millionaire is a dangerous distraction from the real, albeit less glamorous, economic transformation slowly taking place on the ground. A transformation driven by hard economics, not hopeful rumors. Therefore, if you are truly committed to navigating this high-risk, high-potential landscape, you need to become a disciplined, data-driven investor, not a passive dreamer, which is why you must stay connected to this channel for the unbiased, real-time analysis you won't find anywhere else. This is why I urge you to act right now. If you gained any valuable, reality-based insight from this deep dive, then smash that like button to amplify this truth in the YouTube algorithm, subscribe to True Dinar Inside, and hit the notification bell so you don't miss our weekly breakdowns of the actual CBI auction data and IMF reports. Because in a market flooded with misinformation, this channel is your definitive source for the unfiltered economic intelligence you need to make informed decisions. Let me know in the comments below which of the 5 key drivers, oil, reserves, IMF reforms, politics, or market access, you will be watching most closely, and I will personally respond to your questions in our weekly live Q&A session, where we break down the latest developments without the hype and without the lies, empowering you with knowledge instead of empty promises.